I'm James Surowiecki, the New Yorker's business columnist, and we are here today with Joseph Stiglitz, a Columbia economist who won a Nobel Prize in 2001 for his work on imperfect information and the sort of way that translates into flaws in the way free markets work. Stiglitz is also was chief economist at the World Bank and has become one of the most famous and powerful critics of globalization and the way markets work in the world at large. So thank you very much for being with me.
Nice to be here.
So let me just ask you a somewhat frivolous question. Joe Stiglitz becomes president of the United States. What are the biggest changes you would push for in the way in the relationship between government and the economy?
I guess I'd probably begin with the political agenda, because the political agenda is that currently in America, a variety of special interests dictate many aspects of our economic policy and finance and healthcare and energy policy, and make it very difficult to shape the kinds of policies that would make us more efficient. In terms of the bigger think issues, clearly we need to spend more money on infrastructure and technology. We have problems in our K-12 education sector, in our healthcare sector, in our energy sector, in our financial industry that was supposed to be the new source of growth. We confused a means with an end. And we have trouble in our manufacturing sector. So we have a large part of our economy that really needs restructuring. Some of the basic principles, the way we approach the economy, are based on 19th century economics, which are not appropriate for the 21st. 19th century economics, you had a firm that was owned by the person, made a mistake, he bore the consequences. If he had a bad incentive structure, he bore the consequence. 21st century economics, we have big companies where the manager, the executive, owns a very small percentage. So we have a society based on what we call agency theories, right, where everybody's a fiduciary, everybody's acting on behalf of others. But our legal frameworks don't reflect that adequately and the way we think about it. So we have this curious phenomena where the shareholders don't have any say on the pay of the executives.
The people that are their agents, people who are theoretically representing their interests.
I mean, can you imagine having worker working for you and him saying, I don't want you to determine my salary?
Right. And
when somebody says, I want to pass a law saying that you should have say in your salary, saying that's interfering with free market economics?
Right. What's your opinion of the current state of the economy? Where do you think it stands?
We're obviously better than we were. We've ended the free fall. But I think it would be a mistake to think that we are well on the way to a robust recovery. Economists use the term recession when growth is negative. Right. And when growth goes from negative to positive, no matter how small, there's a tendency to say we're over the recession. But for most ordinary people, that's not what they mean by a recession. They mean something very simple. Can I get a job? So the stock market could be going one way when most people are saying this is a rotten economy. Unemployment rates will be going up, wages are stagnant. And then you ask the question, how long will we be in this state? And quite frankly, I'm very worried. I think it's going to be most likely a long time. And the reason is very simple. A lack of domestic aggregate demand. America's savings rate was 0 and is going to go up. It's already gone up to about 5%, likely to go up even higher.
So you think the savings rate will continue to rise?
Yes, and there are good reasons why it should. It's very difficult to predict the almighty American consumer, but their retirement accounts have been devastated. Most Americans' most important asset is their home, and the equity in their home has been wiped out. Right. Literally, just wiped out. About a quarter of American homes are underwater. That means the value of the mortgage exceeds the value of the home. They have no equity. And that was their nest egg. That was what they were planning for their retirement, to send their kids to college. So it's hard for me to see how they won't increase their savings rate. Now, again, you say, isn't that good? Answer is yes, for their
in the long, right, for themselves.
For themselves. But for the economy, if they're not spending the money, it's very hard to get a robust recovery. I had hoped that we would use the occasion of the crisis to try to restructure our economy. Talked about a little bit before about where we needed to go. We haven't done that with the banks. The problem we had before with banks that were too big to fail. And what have happened? We've had consolidation of the banks. The banks have become even bigger. The administration says they're not only too big to fail, they're too big to be financially resolved, to use ordinary capitalist procedures for restructuring them. And the same thing in terms of our overall economy. We need to shift our economy to be more investment. We shouldn't be living beyond our means. And we need to be asking the question, how do we have a viable economy that doesn't depend on profligate consumption?
So what would that entail? More investment in infrastructure and the kind of shift to the green economy?
A shift to the green economy is one important aspect of that. The basic thing is we need to retrofit our entire economy. Again, huge investments are needed. To generate that, we, of course, need to give the right price signals. And the problem is that we have been treating as if it's free something that's very scarce. Our atmosphere, nature, we treat as if it's infinite. And we've learned that it's finite. And that means there's a scarcity of price. But we haven't let the market reflect that scarcity. And if you don't do that, you don't get the right incentives, and so you don't make the investments that you need.
So now, do we need more stimulus? Do we need a bigger stimulus package? A second one? Do we need a different kind of stimulus? Obviously, you think we need a different kind of stimulus.
I think we need another round, and I think I would focus it on several things of trying to think about restructuring our economy, and particularly because there's so much uncertainty, automatic stabilizers, we call them, that titrate the amount that goes in relationship to what is needed. So, for instance, I talked about the shortfall in state revenue.
Right.
If we said the federal government will meet that shortfall, if the economy recovers, that shortfall will disappear, and we don't have to put out any money. The same thing, millions of Americans are about to lose their unemployment insurance. Again, if we fill that in, if unemployment goes down, we don't have to spend the money. Right. So that's the first thing. That's where I would begin. The second thing is I would not have the tax cut except for investment. I would have an investment tax credit to encourage investment, because that's where what we really need, including green investment, but other, it's very difficult for the government to increase spending overnight. We're having trouble getting the money out. Right. But if you have millions of businesses that need to retrofit their investment, their capital stock, well, let's give them an investment credit and use the force of our entire economy. Okay. The other thing, of course, that we need to be spending money on are technology, research, infrastructure, and education. We're doing some of that. I mean, it's moving in the right direction. Need to do more.
So when you list all these things you're talking about, why should we trust that the government is going to be able to make really good decisions about all these things?
First, let me say, I share the view, I think, of a lot of Americans that we've learned that government can make big mistakes. We have had 8 years of the Bush administration. So anybody who had a Pollyannish view of government has been disabused of that. But even before that, I've written a lot about how we create within governments checks and balances. And I said we need a balanced role between market and governments, and I really think that you need to check one to the other. I talked about an investment tax credit because I wanted to use the power of the market to do investment, not just government. So the answer really is that you need to think very deeply about government failure, just like you do market failure.
One example that you would cite, or have cited in the past, of government failure would be the Obama administration's treatment of the banks. So you were, along with Paul Krugman and Jeff Sachs, a very harsh critic of the Obama administration's strategy for dealing with the banks. You, in March, basically said the only solution was nationalization, or some form of nationalization, conservatorship, or whatever, called the Treasury Department's plan, PPIP plan, which the robbery of the American people, and so on. Why do you think it was? Why did you think it was? Or why do you think it was such a mistake?
Well, there are two issues. One of them was that we were pouring money into the banks in one way or another. Okay. Many of the ways very non-transparent, but what was clear was that we weren't getting back value for money. Okay. We were giving them lots of money, getting back preferred shares. Congressional Oversight Panel did a calculation, and they showed on average we were getting, at that time, about 67 cents on the dollar. The value of the shares, they're rotten shares, it went down. And some of the more recent deals probably around 25 cents on the dollar. So we were getting cheated. That was, if you're going to give money, get something back for it. Okay. The second thing was to understand that the incentives are important. Incentives are important. That's a basic law in economics. And the incentives of the banks did not necessarily accord with that of the rest of America. We were giving them money to lend. But we didn't say you have to use the money for lending. And we allowed them to pay out the money in bonuses and dividends. Okay. So it was supposed to be money to recapitalize the banks, and it didn't go there. And it didn't lead to more lending. It was predictable. Incentives matter. That's the basic law of economics. So they did exactly what was predicted. Other countries didn't allow this to happen. Then there was the third problem. We have rules of capitalism. If you can't pay back, you go into bankruptcy in one form or another. We have a special form for banks that we call conservatorship. So what we were doing was breaking the rules of capitalism. It was air Sox capitalism, where we were socializing the losses and privatizing the gains. The Obama administration and the Bush before it had introduced a new concept that had never been talked about in economics, which was not just too big to fail, but too big to be financially restructured. And if you're too big to be financially restructured, there's no market discipline.
Does what has happened since March, the fact that banks have been able to raise all this money in the equity markets and recapitalize themselves that way, the fact that the economy is growing at or shrinking at a less fast pace, the fact that banks are reporting profits, et cetera, does that change your mind at all about your position?
No. In fact, it makes me almost more worried for two reasons. Okay. First of all, had we played by the rules of ordinary capitalism, the banks would have been healthier. The bondholders would have become the new shareholders. Okay. The banks would have been more stable because they wouldn't have to pay out all the money that they now pay to bondholders. Okay. There would have been more confidence. Now, one of the things that worries me is that the way we managed it, we led to more concentration, less competition. That means higher interest rates. That will recapitalize the banks faster, yes, but it will slow down the recovery, because they will be charging higher interest rates, and
on the loans they make, or
on the loans
whatever.
They make,
right.
and that means businesses will be put at a disadvantage. Some of the positive profits come from what they call trading profits. Right. That's gambling. We thought they had learned the lesson. We provide the insurance and they gamble. What does that mean? We're going to pick up the losses. There is a chance, maybe not, but maybe, that we will be in exactly the same situation. They'll be gambling on resurrection. They may do well for a while. Maybe they'll do well enough that we won't ever need another one.
Right.
But in terms of good public policy, if you gamble, you're putting at risk the American taxpayer.
Right. You have a piece in the new, or the most recent, one of the more recent, Vanity Fairs, in which you end in kind of an interesting place. You say that one of the things you are really worried about is that the excesses of American capitalism in particular are going to lead the developing countries in the world to turn away from capitalism and turn away from the power of the free market, which is an interesting thing considering, I think, your reputation in some ways. Can you talk a little bit about where you were coming from there?
Well, I've always believed that markets are absolutely central to a successful economy.
Okay.
And the problem is that unfettered markets are a recipe for disaster.
Okay.
You need to get a balance between government and the market. You need to have the right regulation. You have to have government in there, but government letting markets play their role.
Okay.
But if they look at what's happened in the United States and they say, look, we can't afford that.
What are you afraid developing countries might do that would be bad for them, basically?
Well, I mean, the real risk is something we've seen before, which was the kind of government trying to run everything.
So full-on kind of socialist or something.
Exactly. You know, no government has the information and the ability to control complex things such as an economy. In a way, my work on the economics of information sort of highlighted the importance of having decentralized information. And the markets are an efficient way of gathering and processing information if they're managed correctly.